Alright, hello guys, and glad to have you on board again. Today we're gonna have to dive into this very complex topic that is venture capitalism and, most importantly, capital efficiency. These are two things that most people just don't understand because they're really deep diving financial metrics and things that the normal retail investor or speculator just don't know anything about. So I think that out of the current complexity of the crypto markets, the perspective of understanding all the strings that are actually pulling prices right now, it's of course endlessly complicated. So my job is not to let you know everything about it because no one ever knows that. It's purposely chaotic and complex. I'm just trying to let you know about the major price impactor right now. There is a currently very violent battle going on. On one end, you've got the retail traders who are crazily over bearish. I mean, we're experiencing such level of bearishness that we haven't seen since COVID. So this is basically really what's going on now. These guys are just as bearish as they were in COVID. Like, this is the end of the world. The financial crisis is going to crash us over. The Fed rising. I mean, you know, the bullshit narrative. I've always said, don't follow the narratives. You rather like to follow prices. So the problem is we have this on one end. Retailers extremely bearish. We've figured out that there are signs of clinical depression among the retail's way of thinking, though they might be impacted by their own emotions due to their own body functioning and hormone stuff or whatever. They're really clinically depressed now, and they will not assess the market as being bullish for a long time. Now, even if it rises, they will think that the rebounds are short-lived and just meant to create lower lows afterwards. So this is really the state we're in. And on the opposite end, we've seen that the VC money is getting in hard and really, really hard. And we've got those months' numbers as well, and they are still big enough. This is the reason why I wanted to explain everything about it. This is the reason of my current position and stand in the markets. And I wanted to get into details because I've talked about these things multiple times already. I just didn't really have the time to explain all the depth of it, and I hope today you'll know a bit more about it. So let's jump right in. Okay, the thing is that we've had those numbers. So this month, or last month, it was another nearly $5 billion poured into the crypto market. These are not tokens bought on the market with crazy volatile valuation stuff, whatever. Okay, this is real VC funding directly put into the companies, generally, okay, collateralized with tokens and political implications. We'll talk and dive into this, but what matters is that this month we're starting to see a contraction, meaning that there is a 38% reduction out of the previous month, which was a staggering $7 billion fucking dollars. Okay, that this is enormous amounts of money in just 1 month's lifespan. So crazy money is going in. Remember that the crypto market right now has a fucking market cap, okay, a market cap of around $1 trillion. So 1,000 billion. Okay, so just in 2 months we just got $15 billion, or in a few months we just got enormous amounts of billions. So this is fresh money, not futuristic market caps. This is real money that will help build stuff. So this is what we're going to be talking about today, because there are really two strings pulling the prices now. The retailers are pulling it down, and this is really what's moving prices now. The Luna thing has definitely been a crazy black swan, and it destroyed the bearish, the retail sentiment, pulling us to the prices that we're experiencing now. And even the pros, the smart money, haven't anticipated such thing. So many other professional traders I'm talking to are in the same spot as I am. We're all taking huge drawdown because no one saw this thing coming. That's the purpose of black fucking swans. No one sees them coming. We all adjust. But the thing is that, why do the professionals sustain with their bullish forecasts? They may have delayed it, which is what I do as well, but haven't changed anything. Why? Because we all see that on the opposite end, an opposite force is pulling strings to the upside. That's the VC funding. These things can't be ignored, and every professional knows these things, and they will all look at it. That's crazy shit, folks. Last year we were in a bull market, and we're all 100% more investing in the market from the VC money. So these are the smart money guys I'm trying to follow. I always say, you can follow the dumb money and follow the sentiment. Over time, this is a losing strategy, period. The only way to make money over the long run is to make smarter decisions by acting like the smart money. That doesn't mean you can do it 100% of the times, but you have to reduce your risks the way they do. You have to see the markets the way they do. Risk management and risk limitation is the way to go. That's just the basic of it, okay? So what we do today is, on top of their risk limitation, I'm trying to let you understand how this VC funding works, because boy, I have seen incredible amount of bullshit around that topic recently. So I don't know perfectly about it, but I know more than most of these guys who have said some stupid stuff. So let's dive and jump in with both feet into the VC rounds. How do they work? Why what we see today is nothing compared to the previous VC rounds, the 2008 ICO crazy shit, nothing compared, okay? So I'll explain all about that. So VC money, we have to understand the first thing that lead me to record that thing today. We see the momentum of inflow going down. Once again, the momentum is the first derivative, it's the rate of change, okay? So the rate of change is starting to slow down, meaning that we probably have terminated or getting near the termination of the founding rounds, meaning that probably, I think, the cards are on the table already. The poker play has started already. The deck's been shuffled and distributed among the players. Now we're going to start playing the game. Poker face, and no one knows the future. So we're gonna have to adjust. And this is the first thing you have to understand, because it's kind of a poker game for these VC guys, okay? Now that the party is started, the chips are on the table and they will start moving. Some will start reinforcing and so on. And you have to understanding these things. Okay, so I'll explain this in a second perspective. So we are probably nearing the peak of that money amount. That doesn't mean that these money amounts will not be there next month and the month right after. It just means there will be lesser and lesser inflows on this market. Still positive. Remember that this is money, fresh money going in to support further developments in these blockchains. They're over-financed anyway. So don't worry, these guys have the money to build. So the second question is, now that the round is possibly finished, the second question every professional is asking is, where the fuck is the money? So as we always do as professional, we kind of make a global review and we look at the major actors to try figuring out where they pull their strings. And they've decided, as they have to publish those things. So we know where they're invested in, okay? So I'm going to take a look in here at the major VC funds, because they act like the blue chips, the first ones the flagships, meaning that most of the smart money will look at these guys and probably do the same. Of course, every fund has its own flavor and they all have different choices, but you'll see that out of everything, even despite some have their own personal spices, they all have the same assets. So, for example, Pantera Capital, Bitcoin, Ethereum, everyone has those too. So like I've always said, you want to sell your Bitcoin, you want to sell your ETH, God fucking damn it, look at the smart money. They're all getting into these things. So don't be dumb. Next, Phantom, okay, Polkadot, Solana, Terra Luna, bad luck, Aave, Wi-Fi, Near Protocol, one we're going to talk about, MakerDAO, we're going to see this one a lot. Okay, next, Bitcoin, Ethereum, good luck selling those. MakerDAO, once again, okay, Multicoin Capital, they're getting into Solana, Near Protocol again, ThorChain, The Graph, Weave, these are the names that we're going to see a lot. Okay, next. Oh, Bitcoin, Ethereum, what a surprise. Polkadot, again, Atom, MakerDAO, okay, and other stuff, less attention. Here, Paradigm, Atom, DYDX, MakerDAO. Oh, we've seen those guys again. Okay. Then, uninteresting ones, AVAX, Filecoin, MakerDAO again, Weave, second time, if my memory's right. Avalanche, again, Cadena, okay. These ones, Link, ICP, oh boy, much more speculative positioning for these guys. Okay, and that's it. So this is our flagship, and we immediately see that a few names pull out very quickly. So the Bitcoins and Ethereum, like I said, they're a different category. Every portfolio should have them, no questions asked. Then comes the other ones. We've seen out of the names that recently, that concurrently gone down, we've got MakerDAO, we've got Avalanche, we've got Solana, we've got Atom, we've got Near Protocol, and we've got, so MakerDAO, okay, MKR, MakerDAO, Near Protocol, Avalanche, Solana, Atom. We've seen Polkadot as well on a few, so I would note Polkadot eventually. Okay, but these are the names that come concurrently on many of these guys, okay? So there's kind of a consensus about the flagship investment firms that they want to put some money into these things. So remember that the smart money makes a lot of research. They're not just looking at the goddamn prices and say, oh, we've got a flag bearish fucking pattern in a bull trend. No, they they look at the value, okay? So remember that the speculators, the retailers, whatever, they trade sentiment and they trade prices along with goddammitly stupidly simple trading strategies. And on the opposite hand, you've got the professionals buying the value. So this is a big battle. That doesn't mean the smart money will win. That just means anyway, I will always follow the smart money. That's my job. Okay, so I'm going to follow these flagship guys. I'm going to take those names. The MakerDAO, the AVAX, the Solanas, the Atoms, and the Polkadots and the like. Okay, so these are the names I pay attention to. Always had and always will. This is where the smart money has decided to go. So I will as well. Pure and simple. And the NEAR protocol. The second thing that I will pay attention to is that I want to get the details, because knowing where the money goes is important. Knowing how much is really much more important. How much, when, and how relative to the market cap, okay? Down to the market cap of those assets, how much money has been pulled in will tell me what type of investment that possibly is, because there are two types of funding rounds. Or there are more of them, but the two major ones of them are the VC early funding, which means they're bringing in the first rounds of capital, okay? Though these are generally Series A, and in that perspective, there are initial fundings for a protocol, okay? They're generally balanced with a shitload of tokens that are bought way below the public funding prices, and so on. But these are not the ones we care about. These are like the ICO fundings of the 2018 era. And there are, of course, going to be some early funding rounds today as well. But most of those big guy fundings, okay, the names we've seen, are they initial investments or something? No, there are second types of investment. There are second types of rounds. And these ones have a totally different thing. So first of all, I've seen some people mentioning that the VC funding is a bad stuff because these guys have short-lived speculative positioning or whatever. They're going to pump and dump the assets. I mean, absolute bullshit. These guys don't understand shit about how these mechanics actually work in the background. So here is how it plays out. On the second and later funding rounds, they're generally financially anticipating the organic growth of those protocols. They're generally taking the flagships, the ones that already have value and showed momentum and adoption, and they are going to fund them directly to help them get those network effects and organic growth. And by doing this, you have to understand that the counterparty that we'll get from those rounds are going to be different than the first ones. The first rounds are generally 100% collateralized with tokens. And generally, the VC fundings will provide a lot, like a lot, of professional management, rhetoric, and stuff like that. So these guys will be heavily politically implicated in the protocol or whatever blockchain they're financing. There will be a lot of political implication. You have to understand that in a second round or at a later stage, generally the market cap is higher. But the thing is that these guys, they will ask for both of them. They will still willing to invest to get a risk management. You have to understand that every professional always think about investments that way. We put some money, we know how much we could make, the reward, but we're always paying a lot more attention to how do we mitigate the risk of being proven wrong. So the first way of doing things, meaning that in a first funding rounds, the VC capital generally asks for a shitload of collateral, lots of tokens, and they will help the projects build itself in the most profitable way. On the second type of leveraging rounds, what they do is that you generally have to pull in way more money. We're talking about hundreds of millions, and we'll see them there. What they do is that they want to have political implication on the decisions for these protocol. They will keep supporting and orienting things in the most profitable way, but most importantly, they're in here for the data. What they want is to be inside, to have insider information. I'll explain everything about it. So they will definitely ask for collateral, for tokens, because what they gamble on is for these things to worth more so that they can sell with a profit. But the motivation, the political motivation, it's totally different in a second round. They want to have insider information. They want to know things before the public so that they can orchestrate their risk management. That's the second thing. How the fuck does a VC work at that stage? Not like the first stage of speculative bullshit ICO funding, in which they will take like 200 candidates, pulling 0.5% of everyone, and as time passes, rapidly the bullshit ones are visible and the flagship, the unicorn ones, kinds of emerge quickly, and we're gonna keep working closely with these guys. Let go with those anyway, we're gonna lose all the money, and we're just gonna help these guys make a lot of money. We sell everything at a big profit, 100, 200x, and of course on the overall, 80% of this ended up bullshit. The 2% unicorns we were into gave us a 200x. Overall, we've made a shitload of money. This is how VC funding works. The second VC doesn't work that way. The second VC work like we're gonna take 5 to 10, we concentrate on the biggest ones, the good ones, we make due diligence research, not just the absolute bullshit crap of just looking at a fucking chart and looking for triangle patterns. I mean, the minimum these guys do is everything I've done with you guys, studying supply, demand mechanics, everything. Where's the money? Who's holding it? Who are the other investors? What is the political motivation of these projects? What is the roadmap? Everything. They make huge deep dive to figure out a short and narrow list of 5 to 10 guys. They will put hundreds of millions into these things, okay? And then, like I said, what they want is to get the insider data, because they know that out of the choices they made, the 5, there are very likely going to be 1 or 2 that they're going to have to sell in order to finance more on the 3 leader ones. So what they want is to have strength. Let's assume that they have 100 points to distribute. In the end, they will say, okay, you deserve 10 points in terms of momentum and adoption. You deserve 20, okay? You deserve a 30, okay, gosh, okay? And you are another 30, and you are a 20, okay? So let's put it that, well, sorry, and you were 10, okay. Yeah, that's a 100 count. So in that perspective, what these guys will do is that they will start taking the money out of the 10s to reinforce the 30s, and they will hold on the 20. So you have to understand that when I said the K-fucking-shape recovery is the only possible future is because of this. Now you understand a bit more. The VC funding, pricing, and risk limitation mechanics will cause that, because they will probably pick the winners. But what they will have to do on a second stage is that they will have to reinforce the faster horses, the ones that actually get the biggest type of adoption, or the ones that have the likelier chances to make money over the next 2 years. They're not short-lived, but how do they differentiate, and how do they put their notes like that? This is basic representation. They want insider information. They want to know things before you do. So this is how they risk manage. If they have to get out of something, okay, they will very likely will do it in a bull market. They will start releasing these coins. So this is why I've said we're all down today. All of these coins that they have, the Atoms, the Near Protocol, the AVAX, the Solanas, they're all over fucking sold. So I think those that they've chosen, they will all rebound back to the mean. And here will start the big mix-up. This is where they'll put the numbers out of the insider informations they will have that you and I will certainly not have. This is why I've always said, be ready, folks. Don't follow the ones you think are the best. Follow the money. The money will make the decision on which ones are 10s, which ones are 30s, and which one will have to be more bought, more supported, meaning fresh capital will have to be injected in here. They will buy in the market. And therefore, this means that even if they're all good, there are some that we're going to have to sell in order to finance the buys of the other ones. This is what will inevitably cause the K-shaped recovery. That's the financing round of way of risk limiting for these professionals. Okay, so you have to understand this mechanic. It's crucial for you. So now the second thing to understand is that there's a second factor to this. They do not necessarily pull that much money on everyone. It's not like 0.5% on the 200 project, okay? They will wait on the projects that need more funding, okay? So those who are undercapitalized, they will have to put more money in for them to be ready to put some more money. This is capital efficiency. Those who require more money because they are late in the cycle, the Near protocol, for example, they require more money to catch up on their late stage. But this is, of course, both a blessing and a curse. And you have to understand that final mechanic. Depending on how much they pulled in, meaning that they have more work to do. If that work isn't achieved, or if that work isn't achieved fast enough, or if that work is just piece of bullshit, or even if that's none of them, and if just the other that are also working are working faster and for some reasons manage to make better use of the capital, once again, capital efficiency is all about that. How much use of a dollar do you make? Do you make it a good use or whatever? This is where the insider information is crucial, because these guys will be absolutely emotionless when they will decide which one they hold, which ones they reinforce, and which ones they have to get out of. They will make no stupid decisions. They will be fact-based on insider information. They will decide we've pulled that many $1 million in here, and this is what they end up doing with. They will look at capital efficiency. Where the capital is efficient is where they will reinforce. If you understand that, you know everything there is to know about VC funding, and specifically the VC funding runs that there is for these guys. So now let's look at the money. Let's look at the amount of money that's pulled in. So Near protocol, boy, $350 million for a 2-year-old company. They are very late, but they still see potential if they put that much money, because they think these guys can catch up on the other ones. They better have to be right. We'll talk about that after what is the conclusion. The Luna Foundation God, oh, pretty bad round. Like I said, these guys don't know the future. Polygon, we've seen, okay, quite a significant amount. So the barrel will have to be right with this. Phantom, we've seen, pretty significant round regarding the market cap. Near protocol again, oh boy, that's $500 million in just a few months for Near protocol. For that thing, very much has to catch up on the late stage. And has to be very good. Celsius, okay. FTX, you can see all of the names that you already know about. Dapper Labs, all of these things that you know all about. Nova Labs, interesting. FTX again. Revolut, those I'm looking at is, where the fuck are you? Solana, okay, 314. So interesting, Solana, and where is Avalanche? Avalanche, where the hell are you? Ripple is getting a 200 million C-round series. Interesting. And where the fuck is AVAX? Have I gone through? I think I've passed through it. The hell, where are you? I know it is like half of last year. The hell, Avalanche Foundation, okay, 230 million. So in terms of order of magnitude from the assets that I pay attention to, okay, though first of all, Polkadot is not there, Atom is not there as well, meaning that I filtered in everything that is above 100 million. So if they had funding round, and they did, they have lesser kind of money pulled in, and you have to understand that, okay? So the tinier the amounts means that they think that they do not have to bring more, meaning those companies very likely have the best capital efficiency. The more money they pull in now, the more they have to build with that money. So the lesser the capital efficiency of those companies are. So in terms of order of magnitude related to the market cap, we've got far above everyone else. Near protocol. This definitely means that they're late, they have a lot to buy, and in a short time scale. So it requires a lot of money to succeed. If it fails, the blessing will turn out to be a curse, meaning that all those millions are collateralized by coins, and they will have to sell that many coins to finance the other ones who will be taken as going faster. Remember the choices they will have to make. So the blessing will turn out to be a very damaging curse for those who will be holding Near protocol if the smart money guys decide to get the hell out of it, to get into others. Okay, there will be a lot of coins to digest with very limited demand, of course. Okay, so that means Near protocol, if it's not a winner, it's going to go down fast, and you don't want to be among the ones who will reinforce or buy the dips or whatever shit that is. Okay, huge dangers with Near. Better has to be among the winners. Okay, And that also means that if they are among the winners, these guys will still have to eventually lock on some partial profits. So it will very likely have solid resistances before going all-time highs. Okay, then right before, we've seen that there is Solana at a market cap relative thing. Solana and Avalanche kind of have the same profile, meaning that they're already solid companies but still have lots of things to build. And as well, there is a limited amount of time, but I would say they have an average kind of capital efficiency metric. So that means same old thing, the same old blessing, fresh capital to work, could turn out to be a curse if they are not the winners, but they will have kind of an average thing, meaning that these are the kinds of assets that will have a lot of noise because no one will be able to know. So be real cautious when you deal with the AVAX and SOLs. If we recover in the mid areas of the range, the value areas, it will be hard to distinguish if they're really going up or down, specifically between these two, because I think that's, well, out of SOL and AVAX, I think one of the two is going to fail. I just don't know which one. But be aware that if you're too sensitive on deciding, okay, I'm getting rid of this one or whatever, you might be making bad decisions. So these two might be a little bit trickier to navigate. And here comes the latest ones, okay? Like the Polkadot, the Atoms, and so on. They're on the list, okay? But the thing is that they do not have significant amount of investments, meaning that these ones live on to their own futures. I think they have only the blessing, and they cannot necessarily suffer the curse. They will not be speculated by VC because they have limited impact on these. They probably have a bit of an impact to just get the insider information they want, because this is how they risk limit on these rounds, but you have to understand the way it is. That doesn't mean that the fact that they only have a blessing and not the curse, or that the curse will have limited effect, doesn't mean they will have more chances to succeed. This is a battle, no one knows the outcome. I'm just letting you understand that anyhow and anyway, out of what I just said, you have to understand now that there is no other choice but the K-shaped recovery afterwards. If there is a recovery, on the worst case scenario, if we still are in a bear market, meaning that if the retail's bearish pressure take over, and if the bullish support there is from the smart money through these indirect OTC deals or whatever, behind the desk kind of money going in, if for some reasons the retail wreck that market and take over on a long and prolonged bear market, the thing is that we have a final very dangerous stuff that can happen. Because if prices drop very dramatically, there is a final way in which those VC generally tend to work, which is what I call predator VC investment. Meaning that if they pulled in millions, hundreds of millions, they will not let these things go to zero. Meaning that at some point, if the market caps gets that low, meaning that they've diluted their initial investment very, very dramatically, what they will do is that these are not the guys who lose. These are the guys who will double down. They will raise additional and way more speculative money, generally through lending protocols, through lending, meaning that this will be margin trading. They will buy a major, significant chunk of the circulating supply to get control of the strategy and the prices. And when they do this, the thing is that they will pump to get out, to sell the whole fucking thing. So you have to understand this. If we enter a prolonged bear market, they will have to get out. And this is another way in which they risk limits. So this is, in my personal opinion, definitely not the most favorable technical choice now. But it's one that could definitely work out. And if the bears take over a prolonged bear market, these guys have put millions in an inflationary environment. They will manipulate prices to get out on the assets that they pulled out that money. So specifically the ones that have big money in, understand that these will be pumped anyway in the future, even if there is a bear market. But you have to understand that these pumps will be dumps afterwards if there is this predatory income capital stuff. We'll eventually make a second video about this one if the time ever comes, because in order to anticipate this, it's very complicated to do and lots of tracks have to be followed. Most of you guys just don't know how to see these tracks. So like I said, very speculative. Just want to introduce that knowledge today. We could eventually make use of it in the future, but that's definitely not right now the most favorable stuff. Technically speaking, we have a range in a bullish trend, bullish weekly trend. So I think all of the good assets will recover, go back to the mean, and K-shaped recovery is what's next. No one could have anticipated the tariff fucking shit, but still, these guys have poured in millions. They will support prices if necessary. They do not have endless amounts of money either, which means that if for some reasons the retail pockets end up panic selling more than these guys can buy, prices may fall, and they will eventually 6 months to 1 year from now trigger the secure predatory kind of investment, which will have only one goal: pump up to get the hell out on the retail's faces who will be dumb enough to buy. If that ever happens, we'll make a second video specifically about that. What you need to take out of today's video is how these guys work. What is the strategy? Pick the winners. Know that among the winners, some will go faster than the others, and we'll have to reinforce our exposition to the fasters by probably selling the slowers, meaning that this can only pull out a K-shaped recovery. They probably be winning on 4 of 5, eventually 3 of 5, or some of them will have 5 of 5 of the winners. But understand that there will always be arbitraging. They will beta trade their portfolio, for those who know what I'm talking about. This is really what this is all about. They're going to start selling the weakest ones to reinforce exposition on the stronger ones. They've made their choices, like we've seen. The VC funding, blue chips, the flag chips, they tell us where the money is. There is a clear trend toward a limited set of assets who are already in the top 30. These other assets they think have the most potential. How much money they pulled in is how much capital efficiency they think there is. Related to the market cap, the bigger the investment means the more work there is to achieve. Also, in my personal opinion, that means this is the assets in which if they ever fail or disappoint in some point, they will be the more dramatically impacted by that curse we've talked about. So blessing and a curse is what is the second types of VC investment rounds that we're currently experiencing on those top projects. Every VC has its own spice and will spice its own portfolio due to its own mechanic or whatever, but you have to understand that the flagships are things that every professional fund has in their portfolio. Their trading strategy is radically different from the ICO bullshit of 2008. So whoever is trying to copy that previous mechanism once again today doesn't understand shit about what's really going on. What these guys do is professional growth financing. They are in these projects for 2 years, but that doesn't mean they know the future. If we really enter a prolonged bear market, the curse will be disastrous for those who will be in the assets that these guys bought. If they fail, they will get out, and if you get trapped into this, they will try to get out, and they will be ready to use real complex price manipulation, and if you are getting caught with this, it's gonna cost you a lot, because if they get out, there's no chance these things recover ever again. But, like I said, eventually we'll schedule a second video for this, if ever the time comes. For now, no bear market, so stop bullshitting your head. The sentiment is bear like COVID-2 is hitting us right now. The reality is that these guys see the opposite. Which one do you want to follow? Bye, guys.